For ACA employer rules, your first job is deciding if the employer is an ALA, an applicable large employer. AL status generally means averaging 50 or more full-time employees, including full-time equivalents, during the prior year. On the EA exam, they'll hide part-timers in the fact pattern. You convert their hours into full-time equivalents to see if the employer crosses 50. Next, lock in what full-time means for ACA. It's not 40 hours. It's an average of at least 30 hours per week or 130 hours in a calendar month. That definition drives who must be offered coverage. Exam tip: when you see 120 hours, that's not full-time. When you see 130, it is. If the employer is an AL, the mandate is about offering coverage to substantially all full-time employees. The standard is at least 95% of full-time employees, and the offer must also extend to dependents up to age 26. A key nuance: the penalty system doesn't punish an employer just because employees decline coverage. The offer is what matters. Now, quality of coverage. Two big ideas: minimum essential coverage and minimum value. Minimum value means the plan is designed to pay at least 60% of total medical costs, and it has substantial physician and inpatient hospital coverage. Also, watch waiting periods. Employers can't make employees wait more than 90 days to enroll. Penalties come in two flavors under Code Section 4980H. The big one is 4980H. A. The employer didn't offer MEC to at least 95% of full-timers, and at least one full-time employee gets the premium tax credit through the marketplace. The smaller, targeted one is 4980H. B. The employer did offer coverage, but it wasn't affordable, didn't provide minimum value, or wasn't offered to a particular full-timer, and at least one full-timer gets the premium tax credit. Mechanics matter. For 2024, the 4980HA penalty is $2,970 per year per full-time employee, but you subtract the first 30 full-time employees from the count, and it's assessed monthly if the failure is monthly. For 4980HB, it's $4,460 per year, but only for the number of full-time employees who actually receive the premium tax credit. Exam tip: A uses almost all full-timers. B uses only the subsidized full-timers. Northbridge Financial Group sets up an individual HSA for all employees. The company will contribute to each employee's HSA, and employees can also contribute through salary. Which form must Northbridge file to report its contributions to an employee's HSA? Options include Form 5498SA, Form 1099SA, or reporting it on the corporate return. Think about it. The correct answer is Form 5498SA. That's the information return used to report HSA contributions, including employer contributions, to the IRS. The tempting wrong answer is Form 1099SA, but that form reports distributions coming out of the HSA, not money going in. The corporate return isn't where HSA contributions get reported per employee. An employer is required to withhold the 0.9% additional Medicare tax from any employee who has earned income of more than what amount in 2023, regardless of the employee's filing status. The choices are $150,000, $300,000, $200,000, or $250,000. Think about it. The correct answer is $200,000. Employers must start withholding the additional Medicare tax once an employee's Medicare wages exceed $200,000 for the calendar year, without looking at filing status. The tempting wrong answer is $250,000 because that's a common threshold on individual returns, but employers don't use it for withholding.